as we're talking about this, it's not entirely dissimilar, it sounds like, from insurance, right? You're paying a certain cost to guard against a theoretically more expensive uncertainty. And as we discussed, retailers come out ahead because a lot of people pay for this coverage and never make a successful claim on it, which then subsidizes the few times that they have to pay for it. But what really makes these service plans different from traditional insurance?
So insurance is going to protect you from large, unpredictable losses. Service plans, they usually cover small, predictable failures. And because the cost of the item is known, companies can price these plans in a way that heavily favors them. With insurance, there's regulation and underwriting. With service plans, there's much less oversight and far fewer consumer protections.
Yeah. So we've talked in some of our earlier episodes about insurance about the possibility of self-insuring. Now, for many of the things traditional insurance is good for, that's not practical for a lot of people. But it sounds like this is a place where that might be more in play, where if you're setting aside a certain amount a month or a certain upfront fee that you would have paid for a service plan and just keep that in a savings account, is that going to be a better hedge for a lot of people?
Yeah. So the best alternative to that service plan, it really is to self-insure, meaning save the money instead of paying it to a plan provider. Then if something breaks, you repair or replace it using the funds that you've already set aside. The funds that would have gone toward the service plan, you could instead add those to your emergency fund or keep them in a separate savings account, even with other cash that would otherwise have gone toward a service plan.
Yeah.
Preferably that money is accumulating some interest over time, which can give you some further cushion when a repair expense inevitably crops up.